Welcome to RenMac Off Script, where we will discuss markets, economics, policy, history, and life. It's the 11th of October, 2024. I'm Jeff DeGraff.
I'm Neil Detta.
And I'm Steve Pally.
As a reminder, all the charts that we reference are posted to our Twitter account at RenMac LLC, and we're also on YouTube if you'd like to check us out there. Steve, let's start with you because it appears, depending on the polls, but I think directionally all the polls are roughly in unison here that Trump is gaining an advantage over the last week. And I would just ask, what has happened? It seems like it's been very quiet on the news front. How are we seeing this shift when nobody seems to be making many waves, or is that it? Or is it the waves of these last two hurricanes that are skewing things? What's your take here?
Well, we've had a ton of polling data come up, and I think some have been more favorable to Trump. But what you're really sort of seeing is that it's within the margin of error. I think there's sort of a question we talked about before as to what the general electorate is going to look like. But if you go on the past two presidential election cycles in 2020 and 2016, they're helpful because Trump was at the top of the ticket. You saw a considerable, like 4, maybe even 5% undercount for Trump support. So I think a lot of people are just sort of assuming now that, okay, if Trump is either tied or trailing by 2 or 3, they're sort of assuming that, again, the pollsters are undercounting Trump support and therefore more likely to win the race. And, again, not only have you seen some more favorable polling that's now, if you're going on the Real Clear Politics average, like I know people sometimes take issue with which polls they include versus exclude, but Trump is now ahead in all but Wisconsin, albeit very narrowly, in terms of their averages for the 7 battleground states. I think the bigger movement is in the betting markets. The Real Clear Politics average of betting markets is now almost at 10% for Trump. It may be even higher than that by the time you listen to this, and even predicted, which has tended to be less favorable to Trump. I believe now he's up by 4, and all this has happened in the past few days. And so to your question, why is that? Part of it's the polling. I think part of it too, maybe we've had Vice President Kamala Harris on this media blitz. There are different ways to interpret that. Some, I think more on the Democrat side are saying there's an opportunity to close the deal, get out in front of voters. There's a question of, is she helping or hurting her cause? Because one of the challenges she has is she's sort of positioning herself, her campaign slogan, to new way forward. But every time she's asked what she would have done differently than Joe Biden, her boss, she does not provide an answer for that. And so, it was always going to be a difficult political needle to thread. Doesn't appear that she's been able to do that, just going off the polls in the betting markets. We'll see if that changes. And again, could actions speak louder than words? There's a question of, are Democrats in the campaign looking to put her out more because they're not happy with the trajectory of the race? But again, it's a high risk, high reward situation if she's making matters worse for her. And you contrast that with Trump, his campaign's not really putting him out there, closing the door on a second presidential debate. Well, I don't know any doors ever fully closed with Trump. And really, I think limiting his appearances more towards rallies and less, mass media opportunities that potentially could say something to alter the trajectory that they may feel is heading in a direction. We won't know whether the polls are, again, historically off or directionally off until November 6th, that Wednesday after Election Day. But my sense is that's sort of how to think about the race right now.
It's pretty amazing that both candidates' strategies is to not make yourself available or present. That's the winning strategy. I mean, that's pretty sad, but
behind the scenes, I think there's still much more of a base mobilization. And if you look at where Harris is doing some of her appearances, they tend to be audiences that more aligned with the base. Personally, like I don't watch The View. I know she went on there to try to get that message out, and doing some of these podcasts. Even Trump has done I think some of that, and then obviously his rallies are really geared towards getting out that vote. And again, it's going to be more of a base mobilization effort, which at this point is, I think, probably the focus of both campaigns.
Yeah, I mean, Democrats don't despair. We're all within the margin of error here, right? So this is not a lock by any means, and often at this point you do have a lock. I mean, it becomes pretty apparent who's going to be the winner, and that is still not the case, though. At the margin, we're seeing this shift more towards red than blue. Let me ask maybe a more pointed question, which is, what's the first order of business? If Trump gets in, what's his first order of business?
Well, it depends on who you ask. Some say will be to seek retribution against his political opponents. I'm not going to touch that one necessarily, but I think you can probably count on the tariffs. I believe that's something he feels pretty strongly about. And I think that's also something he might view his reelection as sort of indication for his approach. So, where you might want to position yourself, in my opinion, would be small caps tend to be more domestic focused. If he has a Republican sweep, small caps might also benefit if Republicans try to actually lower the corporate rate for domestic manufacturing to 15%, as Trump has suggested. I think they probably benefit a little bit more from just a broader reduction in corporate interest rates, maybe some of the bigger folks that can take advantage of some of the creative accounting services offered by people who can afford them. And then I would maybe see down the road this idea of releasing the GSEs from conservatorship. That was something that Trump talked about doing the last go around. I think there's more commitment to that this time. So that's something I would look for immediately. But again, the thing that's you really got to keep an eye on is regardless of who wins, do we have unified control by one political party winning the
Right. And
House and the
what are
Senate?
the probabilities of that right now? Do you know?
The markets, in my opinion, are probably pricing in the odds of a divided government. Republicans have a very favorable Senate map. We've talked about that in the past. They should pick up West Virginia. I think that's almost a given. And Montana race is moving sort of out of within the margin of error in favor of the Republican challenger there. So that would get Republicans to sort of a floor of 51. That's why I think Democrats are trying to redirect attention now, knowing that I think West Virginia and Montana in particular are lost causes, to try to save Ohio and then try to pick up maybe Florida or Texas. I think they're going to face long odds there. And then in the House, Democrats have the advantage. And so I think, probably at this point, decent chance of, if Trump wins, Republican Senate, and probably better chance of a Democratic House. But I wouldn't put that much ahead of just the Republican sweep scenario, just because a lot of these House races, particularly on the margins, if Trump's overperforming the polls, there's a good chance he may carry them across the line. I do think it's going to be harder because of the Republican Senate advantage for Democrats to execute a sweep scenario, but they're polling mistakes and election surprises happen.
Yeah.
The thing that I would watch there is, in the event of a Democrat sweep, Kamala Harris has talked about supporting removing the filibuster, and she mentioned that would be for abortion. But once you crack that open, it really you can't get that toothpaste in the tube back in the tube. And I think that'd be really important to what would they do on the tax and spending side, because you wouldn't be bound by budget reconciliation in those 10-year windows from the budgetary perspective. With the filibuster gone, I mean, anything's free game at that point.
Interesting. All right, let's go to the real world. Neil, we had inflation this week. That number was a little higher than the Bloomberg consensus, but it was kind of in line with the whispers. Any surprises from you, and what does that do to your Fed call and Chair Powell between now and the end of the year?
Yeah, well, I'm just reminded of that classic line from Jay-Z: prices go up and down like it's Wall Street. It's worse than the Dow Jones. Your brains are now blown. My brains feel like they're getting fried with all this data going around. I mean, we were kind of right in the strike zone for a soft landing. Basically heading into October. I mean, obviously the Fed went 50 basis points. And then the data that's been released since the September FOMC meeting has kind of pushed the markets back into this kind of inflationary boom type mindset. I mean, it started with the employment report, obviously, and the drop in the unemployment rate. And then you got, this week we had a series of inflation data points that were, at the margin a little bit firmer. I do think core CPI frankly overstates inflation, particularly when you think about the Fed's preferred measure of inflation. So when you do the translation of CPI and producer prices, and you try to make an estimation for core PCE, that looks a little bit more benign. We're at 0.2%. It could be a firm 0.2%, but it's going to be somewhat softer than core CPI inflation. So I think it's enough for the Fed to cut 25 basis points in November. But look, the markets right now are kind of toying with the idea that the Fed skips a meeting by the end of the year. That is starting to creep up a little bit into the market psychology. Atlanta Fed President Bostic kind of put some life into the idea, saying that he'd be, open to skipping next month. I don't think that'll happen, but it's just kind of tells you about where the way the markets are the winds are blowing right now.
Is he being reprimanded for that from Chair Powell? Is there the chairman's on the phone for you? Is that happening?
No, I mean, I think that he lets people speak, but ultimately we know that he does what he wants. If you learned one thing from the September FOMC meeting, it's that Powell takes all the opinions on board, and then he just makes the decision that he feels like making. So you're welcome to speak, but ultimately the decider, I think, is Powell. And I guess what's interesting is I think the baseline for November is still 25. I don't think that they're going to skip. But I think to the extent the markets are pricing in or starting to price in a potential skip in December, I think that brings a whole host of issues for the Fed, right? I mean, if the Fed starts breathing life into that idea, I think the risk, of course, is that the markets will just price in the end of all the easing. And you'll get a much more rapid increase in interest rates. But I also think it's probably not consistent with the data. I mean, I think the baseline for the economy is still one of gradual cooling in the labor market and gradual cooling in inflation, which should support ongoing easing of monetary policy. Frankly, I mean, this sounds crazy right now, but look, I don't think you should rule out a 50 basis point move before year end. I don't think that's what we're going to get in November, but think about what we're going to see next month. I mean, we know that initial claims are rising because of hurricane effects. They didn't rise only because of that, but that was certainly a part of it. And so when the October data are released the Friday before the November FOMC meeting, it's plausible that Powell's looking at a fairly meaningful increase in the unemployment rate and a slowing in jobs growth. And at the same time, remember that the response rate on the September NFP data was actually quite low for September. So as more data becomes available and more of those surveys responses come in, it doesn't tell you about the direction of the revisions, but it does suggest that there will be revisions. And, my guess is that it's probably somewhat lower because certainly there's, the momentum behind the labor market going into that number was quite weak. So, I think you can't rule out a scenario where the jobs number right before the next Fed meeting is one where the unemployment rate going up. And yeah, maybe the October number itself is a throwaway because of hurricanes, but what if the prior months are revised down? What does that do? I don't think the totality of that would be consistent with skipping in December.
Right.
And then you kind of look at the next jobs number after that to kind of break the tie. But you have to, I mean, this is a very sensitive sort of thing because this is not like, normally you kind of think like, yeah, they should just look through these things. But remember that the Fed believes that the risks to the growth outlook are skewed to the downside. That's what we saw in the September meeting. That's a big difference from what we saw back in June. That was one of the key differences in the summary of economic projections, the balance of risk assessment. More of them think the risk to the unemployment rate are to the upside, growth to the downside, which is a difference from where we were in June. And, you think about like Katrina, right? I mean, that's kind of the thing that people think about when you get these sort of storms and the big economic impact. The economy, remember, the Fed basically looked right through that and they kept hiking. There may have been a descent to kind of take a pause, but, the momentum in the economy was in a much better place then than it is now, particularly the labor market. I mean, unemployment was clearly declining. We were generating about 250,000 jobs a month in the 3 months leading up to it. So you can't really say the same now. So, you know, I mean, it's something to keep an eye on, but I think for me, the bottom line is the markets have taken a lot of signal from one jobs number. And, you know, kind of going back to this sort of inflationary boom-like dynamic, I don't think that that's really the baseline case right now. And I get it. Look, I mean, people, I mean, it kind of ties into what Steve was talking about before. I mean, it's hard to want to buy bonds if you think Trump is about to win.
Yeah, I was just going to ask you that. We've got the first overbought condition in yields, right, in the 10-year yield since April, so about 6 months. Are bonds a buy here? I mean, technically they are.
I think they are, but I mean, I'd probably lean more towards the front end than the long end, because I think people are a little bit skeptical of going long duration because of the potential outcome from the election. So you know, that would all else mean, I guess all else equal imply a steeper curve. But you know, I think that there's opportunity in the front end of the yield curve, because I don't think things have changed that drastically for the Fed. And I think in Q4, there's still potentially some weaker economic outcomes that might lie in front of us, right? I mean, I think the outlook for investment is clearly slowing. I mean, the fact that rates are up here, I mean, don't expect any turnaround in residential investment. I mean, housing is going to look weak in Q4. And between, you know, things like the Boeing strike, the fading of some of the, you know, structures investment tailwind we got from the CHIPS Act, you know, you shouldn't be surprised to see, you know, equipment spending and things like that slowing in Q4. So I think both non-residential and residential investment will look pretty soft in the fourth quarter. So you still probably have some kind of weakness in growth in front of you. And we had a very strong quarter for consumption, which probably won't last in Q4 because, you know, generally speaking, the overall tenor of labor income has been slower. I mean, that was true even with the September jobs number because the work week fell. So, you know, I think there are a lot of moving parts, but I do think if I had to simplify it into one thing, the markets think things have really changed with that last jobs number, and I'm skeptical that that's the case.
So an overbought condition since 1962 historically has been good for the S&P. So, you know, I think that's pretty interesting because we are reaching this point in seasonality where the calendar improves, right? So whether it's an election year or not, markets tend to do well from this point through the end of the year, actually into January specifically. But when we look at these overbought conditions in downtrends, good for copper, good for the S&P, from a stylistic standpoint, it actually tends to be better for cyclicals than defensives. And, you know, we were on the defensive trade for much of the summer, and that proved to be right. But we're starting to gravitate back towards the cyclicality now, partly because of this, partly because of our market cycle clock, partly because of seasonality, and just looking for breakouts, right? We had a breakout in NVIDIA on a 3-month relative basis. We had the Broadcom chart starting to break out, a few cats and dogs in discretionary starting to act better. And by the way, discretionary is on a relative basis the best performer coming out of an overbought condition in a downtrend for yield. So we'll continue to watch these things as we go in through the end of the year. Interestingly enough, on the other side of it, what tends to lag, what tends to underperform, profitability from a style standpoint or factor standpoint, quality tends to underperform, utilities, energy, REITs, all those tend to underperform. So pretty consistent with what that dynamic is around the regime of an overbought condition in a downtrend for yields. I think one of the more interesting things from the market's perspective is what we're seeing, and we put this chart on X or Twitter. The chart's for visualization. We do some math behind it, which is how we really get to the conclusion. The math isn't pretty. The math is not, you know, where you're going to attract people and gain interest. But what we're looking at is basically the spread volatility. So volatility equals risk or the perception of risk. So we look at the VIX and then we look at the option adjusted spread in corporates, you know, which is an indication of how risk tolerant the credit markets are. So you've got the risk tolerance or perception of risk through volatility in the VIX, and then you've got the spreads. And when that spread's high, in other words, when the VIX is elevated, but you're not seeing the same type of elevation or concerns out of fixed income, it tends to be bullish for the market out the next quarter. And right now we're in the top 5 percentile. In other words, there is this concern. I'm sure it has to do with the Mideast. I'm sure it has to do with the election. But those concerns that are being reflected through volatility in the equity markets are not having an impact on the credit markets. And, we view that historically as being bullish. And what it really means is that the equity markets are concerned about noise, and the credit markets, which are notoriously concerned about just being paid back, just don't have those same concerns, that whatever this kind of sideshow is, it's likely not to have an impact on credit. And that tends to be bullish equities. So we'll watch that as we go forward. But I do think that is something that also plays into the market cycle clock, also plays into this overbought condition in yields and the seasonality. The other thing I would just mention, and it's not statistically, it's not that meaningful. I think you can kind of build a story around it depending on your biases or your view. But we've seen this big, call it 6-month consolidation in Bitcoin. And what was interesting is the commercial hedgers were really pumping Bitcoin up through that 50,000 level on its way to 70,000, and then selling it pretty dramatically at that peak or near that peak, and continuing to liquidate as we were going into this elongated consolidation. They've started to pick up that net exposure. This is through last week's data. We'll get the other data later this afternoon, but they started to pick up that exposure pretty meaningfully, almost back to those old highs of net long exposure in a consolidation. In other words, they've kind of quietly been upping their exposure, their ability to profit from the breakout or the long side, as we've been kind of quietly digesting this. We're not seeing it in the chart yet. The chart's still in this consolidation mode, potentially a top mode, but certainly I like the positioning of these commercial hedgers in this consolidation. They're not fleeing the exit. In other words, they're not under distribution. They are actually supporting the market and the price here. So we'll see how that plays. Steve, what's going on next week? Is it all just election and polling and, kind of more of the same, so I can close my ears and not listen to not you per se, I'm sorry about that, but just what's coming out of your neck of the woods?
For the most part, yeah, continue to watch the polls, not only the presidential level, but down ballot. Again, the importance of whether or not it's going to be divided government or unified government, really important, because most what both candidates are proposing requires legislation. Outside of the US, I keep an eye on the Middle East, just because there's sort of this question about what type of response Israel is going to provide to Iran. And then you sort of have Iran's response to that. There's been some reports out that Iran sort of warning other Arab states that they could potentially be targeted if they're seen as sort of aiding Israel in this, and that could disrupt oil supplies, and also question of whether or not they could try to limit oil being transported through the Strait of Hormuz. Anything that could potentially disrupt gas prices ahead of the election is always something that I know is of interest to the White House, if nobody else.
Won't the Iranians be more on their best behavior, let's call it? They can't want Trump in the White House.
They're trying to kill him. I mean, there are multiple assassination reports. Even the Biden administration has briefed Trump on Iranian attempts to kill him.
Wait, does that count as election interference, or is it only when Russia does it?
I'm not going to touch that one. But
You know what I thought was interesting is that a friend of mine pointed this out to me. So I see that former President Obama is now on the stump. And I think they also got Bill Clinton on the stump trying to appeal to rural voters. But the Obama one is interesting because at this point, he's been campaigning more in his political career against Donald Trump than he even has for himself. You think about it, right?
Well, there's also a name that you didn't mention, that was Joe Biden, that they're really trying to advertise out there, trying to campaign for Harris. And that was sort of interesting to see how this week you had this back and forth as to Kamala Harris and Florida Governor Ron DeSantis. And, Harris suggesting that, DeSantis wouldn't take her call because it was political reasons, and DeSantis sort of responding that she never called me for any of the other storms. Why would I take her call now when I talked to her boss? And perhaps it was just miscommunication. But Biden sort of saying, no, that he's been in regular contact with DeSantis, and they have a pretty good at this point relationship and idea how to handle the storm. So
the only reason Clinton was on the stump is because Cosby wasn't available.
again, I'm not going to touch that one.
I mean, I think it's an interesting kind of, it's just thinking about it. It's interesting.
Well, if you notice, DeSantis played very nice in the sandbox with Biden, right? And they if you saw whatever the communications were in the photo, like there was no no animosity. They were both gracious to one another, which did not, I don't think, play well for what Harris was trying to do there. But I mean, these games are just unbelievable.
Well, I mean, just think about your future political aspirations too. I mean, a lot of people point to it was 2012 when New Jersey Governor Chris Christie hugged Barack Obama, and there's probably not a coincidence that sort of ended his political rise and ascent there in the Republican Party.
Man, somebody somewhere is always keeping score, aren't they? Neil, what do you got next week for data?
So I think the main event's going to be the retail sales number for September, and I think the risk is that it continues to fuel this chatter of this inflationary boom-like dynamic, because there may be some upside risk to retail sales because of the hurricane, right? So you get this kind of stocking up effect where people go out and buy food, groceries, they go to Home Depot and buy wood boards to plank up their house, things like that. So you kind of see this pull forward of consumption, I mean, not unlike what you saw during COVID, right? I mean, it's like what happens in front of a natural disaster. So that could kind of juice the retail sales data higher. Now, obviously, we also had, a better auto sales number as well. So, we'll see. But I do think that the risk is that retail sales kind of continues to fuel this, like, consumer spending is strong. We're back to an inflationary boom. Neutral rates are a lot higher. The Fed's making a mistake by having cut 50. Why are they thinking about still cutting? So I think that there's some of that that's possible by the end of the week. That might be the narrative. We'll also get data on industrial production. I do think manufacturing production is going to be soft. That's primarily because factory hours worked have basically not been going anywhere for the last couple of months. We've seen manufacturing employment come down, so I think it stands to reason that factory production is coming down as well, unless you think that there's like this big productivity boom going on in manufacturing. I mean, there's not much evidence for it, but those are the two main events. And of course, we'll be keeping an eye on jobless claims. The fact that initial claims spiked, you probably see ongoing increases in continuing claims, which would imply higher unemployment.
Well, we'll continue to watch the cyclical versus defensive trade. Again, looking for more affirmation that is starting to move in the historically precedented direction, if you will. So things like consumer discretionary breakouts there, things like breakouts in technology, which is, really has been still lackluster with the exception of a few names. Things like breakouts in industrials, even banks would certainly be helpful. Weakness in utilities, weakness in healthcare, weakness in staples, all of those would be part of the backdrop for that cyclical trade between now and year end. And again, keep in mind, we do enter this seasonally strong period for markets from this point to the turn of the calendar. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and on YouTube. And if you'd like more, join us at renmacaccess.com for some deeper insights. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.